Hello, a very good afternoon, everyone. Okay, welcome to our 2026 first quarter of a market outlook. So on these sections, our analysts will be sharing with you some of their outlook on the economies and also equity market. And of course, they will be also sharing some of their shares that they are monitoring. All right. So without further ado, first I would like to invite our head of research, Victor, to share about his outlook on the economies. Welcome.
All right. Good evening, everyone. Hope you can hear me. Actually, I need to correct Dexter there. I'm not the head of research. I'm the executive director. Our head of research is actually Mr. Kenneth Leong. But nevertheless, thanks for joining us tonight, this evening, as we present to you our first quarter 2026 economic and market updates. So as you can see from the title, things are looking steadier. Which has been in the fourth quarter of last year. And now we're seeing the same conditions heading into the new year. So we'll get more into that as we proceed. Um this will be just a very quick disclaimer. Right, so for today, this will be our agenda. We will start off first on my side, the global and Malaysian economic review. I will also touch on the economic outlook, which will be followed by Kenneth on the equity market review and the market outlook before concluding with our analysts that will provide you with some of the updates and recommendations for the upcoming quarter. Right? So, very quickly moving on first to the economic side of things. I'll start off first with the global economic review. So as you can see in the table, in the third quarter of 2025, that's the latest readings that we have. You can see the conditions for the most part has remained relatively stable, with growth anywhere, with growth that were matching that of in the second quarter of the year. And of course, all this is mainly due to the delays in the implementation of US tariffs as well as the tamer inflation now. But having said that, the growth rate is actually quite uneven. So if you look at it, for example, in Germany and France, the growth rates were not really that fantastic. Whereas if you look at the stronger growth, it will be very much in the US and of course in the eurozone in general. So uh, basically, overall, the sentiments also became more guarded from the impending tariff implementation, and at the same time, also towards the end of the third quarter, a lot of the front-loading activities that were prevalent in the second quarter and of course also in the first quarter of the year came to an end now. But nevertheless, there was still very much firm consumer spending growth. Part of it is also helped by the lower interest rates as well as the increased capex spending, particularly on technology-related segments that aided the continuing growth. Also, at the same time, employment uh, conditions were also mainly steady, and that allowed for global growth to be sustained into the third quarter of the year. Right. So, as I said earlier, as the front-loading activities wound down, global PMIs in terms of manufacturing and the services PMIs. Here we're talking about the JP Morgan Global Manufacturing PMI. It actually slowed down quite a bit, uh, and it is again tethering on the 50%, sorry, the 50 level, which separates growth from contraction. So not much movement as the front loading activities ended. At the same time, also, even though the services PMI index were still on the growth path, the growth rate was much lower as things became a little bit more cautious with the onset of the tariff implementation. which came about in September. So overall, if you look at it with the tariff effects uh, not coming in that soon, US GDP was again the outperformer, again beat expectations in the third quarter of the year, mainly on the back of the strong consumer spending as well as government spending. There was also a pickup in exports, which grew nearly 1%, offsetting some of the lower capex spending during the quarter. As far as Europe is concerned, growth rates, as I've pointed out earlier, were very much on a steady course with increased government spending and an increase in investments helping growth up. As far as Asian economies in general, they actually rode on the firm domestic activities. And this actually helped to cushion against the weaker external environment. So that is a quick update on the global economic conditions in the third quarter of last year. Moving on right now to the Malaysian side. So on the Malaysian side, we actually grew at a stronger rate of 5.2% year on year, and that compares against the 4.4% GDP growth recorded in the second quarter. So cumulatively, 9 month GDP growth was at 4.7%. Again, very much driven by resilient domestic activities. There was also a strong increase in tourist arrivals, as well as an improvement in exports in general. But having said that, much of it is actually from the exports of the E&E products, and that was also due to the upturn in the electronics upcycle. Right. So if you look at on its own, the private consumption remains the key growth segment. Basically, consumer spending growth was very strong. Um, this was helped by the government's targeted cash transfers, including things like SARA and SPR, as well as the sustained capex spending by the private sector, as well as the government. So even with the increased consumption, domestic demand growth moderated slightly, mainly due to the lower public and private investments that only grew 7.3 or to 7.4% in the third quarter of the year. And this compares against the investment growth of more than 10% in the previous quarter. Right. So that has been the drag for domestic demand growth in the third quarter of the year. Overall, though, the gross fixed capital formation expansion was also slower at just 7.4%. So you compare that against the 12.1% growth in the previous quarter. There was still very much investments into structure and machinery. Whereas if you look at the exports of goods and services, uh, as I said earlier, apart from the E&E products, it actually turned softer. Part of the reason for the stronger growth in the second quarter of the year was mainly due to the fund loading activities. So as we head into the actual implementation of the tariffs. So in a broad sense, U.S. tariffs were set at 19% on most Malaysian goods in August. So that actually weighed on some of the export momentum compared to the front loading activities earlier in the year. If you look at gross exports, it actually rose 6.7% year on year, mainly on the back of strong E&E exports, and that also helped to bolster the trade surplus to 50.3 billion compared to 14.3 billion in the second quarter of the year. If you look at the services sector, it actually posted another strong performance, 5% year-on-year growth. Again, it is very much underpinned by the wholesale and retail trade subsector, which we have noted earlier was mainly due to the continuing government aid, as well as the arrival of the strong arrivals, tourism arrivals. So, so all this actually helped to contribute to the improved services sector performances. In other sectors, the agriculture sector turned in a very modest growth, well, barely improving in the third quarter of the year, mainly due to weaker palm oil prices. Whereas if you look at the mining and quarrying sector, it actually returned to the positive side, jumping nearly 10% due to higher manufacturing, higher energy demand per se. Right. On the manufacturing side, manufacturing's growth as a whole was up by 4.1%. This is actually stronger than the 3.7% growth in the second quarter of the year. So again, it's mainly on stronger demand for E&E products as well as optical products. So collectively, the demand grew by about 8.5% year-on-year in the third quarter. Right. So as far as the construction sector is concerned, uh, the construction sector posted a double-digit growth again at around 12%. So little change from the second quarter of last year. Again, it is attributed to the broad-based expansion of uh, of civil engineering works as well as the continuing work on data centers. So overall, if you look at the chart on the right hand side, you can see that most of the key manufacturing statistics like industrial production, exports, manufacturing sales, and of course the manufacturing index, they were actually on a strong recovery towards the second to third quarter of the year, largely on the back of the stronger demand for E&E products, and domestically very much so on the production of food and building materials. Right. So now let us move on to the outlook side. Okay. We'll start off first with the global economic outlook. Looking at the 2025's statistics, the forecast for most countries has again been lifted due to the strong underlying performances year to date. So earlier on, we saw for 2025, the estimates were around 2.6% year-on-year growth. Now it's looking at around 2.9%, mainly on the back of stronger third and fourth quarter performances. Similarly, if you look down the table, you can see that a lot of countries in this uh, table, either they maintain their growth rates or seeing a slight uptick in the forecast. Much of this is actually based on a stronger consumption and fund due to the front loading activities. But moving into 2026, if you look at it, the growth rate globally has been upped again from the previous estimate from about 2.3 to anywhere from 2.3 to 2.9% to now at 3%. Much of it is basically due to the ongoing stability, newfound stability in the fourth quarter of the year. So that is likely to carry over into 2026, at least for the first half of this year. And a lot of it is still due to the combination of firm employment prospects, control inflation despite the implementation of the tariffs and the reciprocal tariffs that is still aiding the consumption patterns. So at the same time, also lending support is the various or the interest rate cuts that had promoted a lot of spending, and a lot of these interest rate cuts were organized in 2025. So with the lower rate, it is seen promoting consumer spending. But then again, consumer spending growth in 2026 is unlikely to match that of the growth in 2025 due to the lingering inflationary concerns as the tariffs come into the market, and of course that there is also the concerns that employment and wage growth may soften in 2026. Even so, I think if you look at it, global investment spending is likely to stay very strong, particularly on technology, the technology sector, given the advent of the AI phenomenon. A lot of this would also be due to lower interest rates that will allow for more spending into capex, more spending into AI capex. In some estimates, they are looking at something like $500 billion worth of investments has already been poured into AIs, and more of the same will be into the AI sector over the coming 2 to 3 years now. As far as interest rates, there is still uh, the prospects of further reduction in interest rates in 2026 likely to materialize. This is basically as inflation still at the low end of expectations. So this gives the central banks the opportunity to to lower the interest rates further lah. But nevertheless, I think that further cuts can be a bit more modest, as most of the interest rate cuts in 2025 has already reflected and becoming very neutral at this stage. Lah. In terms of trade, the World Trade Organization is just looking at less than 1% year-on-year gain in global trades in 2026. So you compare that with the previous estimate of nearly 2% now. So a lot of it is based on the uncertainties on the impact of the US tariffs as well as the reciprocal tariffs on US goods. At the same time, also, the front loading activities that contributed to much of the global trades last year is likely to fade. And as a result of it, the global trades will also become more choppy as economies um, try to the impact of the tariffs. Even so, at this current juncture, inflationary are not uh, really that substantial at this point. So potentially, the forecast is for global inflation to come in at around 3.4%, which is little change from the estimate of 3.5% for 2025. This will likely see the tariff effects continue to come into the marketplace and possibly affecting margins as well as spending. But nevertheless, um, there is the impact is likely to be higher than many central banks' comfort level for inflation at 2%, and that is something that could worry central banks as well, because the prolonged duration of high inflation rates could force the central banks to actually raise rates or at least keep the interest rate stable for much of the year, right? So all in all, if you look at the conditions right now, there is apparent stability in the global economic outlook. But nevertheless, the global recession risk is still heightened at around 30% now. What is the biggest concern is the amount of spending onto AI related uh, in activities, and that has not really contributed a lot in terms of revenue and growth to to the uh, um, the bottom line of many of these companies. Therefore, there is still a risk of the AI bubble expanding, and this could pose a um, significant risk to the economy in general. So there are also concerns that the global employment prospects will be softer, affected by the ongoing uncertainties lah. So that could also lead to a tempering of the consumer spending, as well as slower demand and the production outlook lah. So overall, if you look at it, the US will still continue to drive the global economic environment in 2026. But for now, the growth rate is not going to veer very much from 2025's estimate of 2%. For what it's worth, growth will still continue to be anchored by consumer spending and private investments. But the big caution here would be inflation and weaker employment. So in 2026, the actual unemployment uh, rate is actually forecast at 4.5%, which is creeping up from the current rates. Also, US exports are likely to stay weak in 2026 with only a possible growth of 1%. Um, this is mainly due to the continuing trade or tariff war among the US and its trading partners. Lah. So that is likely to dampen growth. Lah. As far as Europe, European outlook will remain stable. GDPs of anywhere from 1.2 to 1.4% year on year in most of its member companies. Mainly, growth will be sustained by tamer inflation, and that is helping to shore up consumer spending. At the same time, also employment prospects are holding for now, so that would actually help to cushion against the ongoing trade concerns as well as slower demand growth. There are, of course, lingering geopolitical concerns and continuing supply chain vulnerabilities in the European region. As far as Asian economies, um, it is very much going to be supported by strong domestic activities and as well as the ongoing global technology upcycle. And that will provide sufficient demand for E&E exports, particularly from countries like China, South Korea, and Japan, that are big producers of E&E products. So that is a quick outlook on the global side. We now move on to the Malaysian side. So looking at the table, the consensus estimates for GDP in 2025 again has been lifted. So now we're looking at a growth rate of potentially about 4.7%. So this comes amid the strong performances in the for the most part of the year, mainly on the back of the front loading activities. So fourth quarter GDP is now expected at around 5%. So that would lend support to 2025 GDP performances. And at the same time also, with domestic activities to also continue supporting GDP, the economic growth, and as well as to cushion against the uncertainties in the external sector. Okay, um, consumer spending in 2025 is expected to improve by about 5%. So that is very much seen as the catalyst to shore up domestic activities, which is expected at around where its growth is expected around 5 to 7% year on year in 2025. And also, a lot of it is coming from the spending on infrastructure and capex on E&E products. Right. Moving on to 2026, conditions are likely to become choppier and is likely to pose some moderation. So previously from the table, you can see that the forecast is for growth in 2026 is now at 4.4% compared to 2025's 4.7%. So if you look at the general that's the general consensus. Even the government is putting it at anywhere from 4 to 4.5% growth in 2026. So this is mainly on the back of the increasingly challenging external sector, especially the demand for Malaysian goods, as the effects of the US tariffs are filtering more into the economy. So that means the demand for manufactured goods is likely to become more become softer after the 2025's front-loading activities, and of course, higher prices from the tariffs passed through could also reduce demand for Malaysian products. So so as I said earlier, the GDP forecast from the government is actually looking at a growth of about 4 to 4.5%, which is lower than which is lower than the consensus estimate of 4.4%. But if you look at the growth rate in general, the it is actually uh, quite decent given the challenges of the global economy. All right, and because we are such an open economy, we have our economic conditions and prospects are very much correlated to what happens in the rest of the world. So for now, the Malaysian export growth may only grow about just about 3% year on year. Part of it is also due to the moderation of E&E products after the strong demand upcycle in the past 2 years. So we also see some saturation in market conditions. Uh, in all, the manufacturing sector growth may ease to just about 3% in 2026. Not too bad considering that 2025's estimate is only about 3.8% year on year. So what is going to provide support to the manufacturing sector would be very much on domestic centric manufacturing, for example, on food and beverage products, as well as for building materials. So that will provide the cover some of the shortfalls from the weaker external demand. At the same time, also, if you look at it, domestic spending is likely to remain fairly firm, given that the employment prospects is now looking firmer. So there's very little change in the unemployment forecast for 2026, which is around 3%. And that is actually coming mainly from increased tourism, easing inflation, and continuing government aid that will help domestic spending in 2026. So with that also, you can see that the wholesale and retail segment will again lead the domestic activities higher, and we're looking at a growth of about 5% in 2026. You compare that with the official forecast of 4.4% year on year in 2025. Further providing support to domestic activities would be private and public investment spending growth of 5.7 and 4.4% year on year, whereas the strong construction sector will also augment growth in 2026. So overall, inflation should remain under control, even as it could climb slightly to about anywhere from 1.3 to 2% in 2026. As far as interest rates, at this point, it appears accommodative, even if there is just a minor uh, uh, reduction in the Malaysian interest rates, and this will help to uh, cushion against the global economic headwinds. So looking at the actual government forecast in 2025 and 2026, you can see that there's not a whole lot of difference, but uh, growth is likely to be softer in 2026 due to the softening global economic conditions. So I've come to the end of my section. I will pass you on to the equity side of things, which our head of research can present to you, where there are some questions relating to the economic side of things.
So there's a question from Mark Chance. He asked that for 1 year post on the US and China trade tariff revisions, how does it impact when due in a quarter 4 this year?
Again, I would caution against reading too much into all of this at this point, because it's still very far away. But looking at the geopolitical issues that that they are facing right now, you can see that the US is trying to counter China's dominance in certain ways. So what the how would the impact be at this point? I think is anybody's guess, because knowing that the President Trump is likely to revise his plans as he goes along. So the impact, if we just look at it at the face value, definitely China's exports will be affected if if President Trump carries out his threat, or I should say his plan to 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 end the pause on the tariff revisions later this year lah. But again, everything is very fluid at this point, and anything can change.
There is another question. Okay. With the reducing Fed rates, will that help in US housing and renovations that may benefit Malaysia furnitures later this year?
Okay, in terms of furniture, I think that sector, well, the US government is intending to levy or put a tariff on Malaysian exports, furniture exports, but they have not finalized it. All right. Now, if they were to actually put a tariff on Malaysian furniture exports, I would think that it will be very much affected, given that our furnitures will not be that effective, will not be that attractively priced when it reaches the US. So regardless of what happens to the interest rates, and even if there's a boost in US housing and renovation, the benefits are unlikely to be uh, straight up for Malaysian furniture manufacturers.
There's another question. By looking at the outlook, what do you think about Malaysia bond performance, and especially for the G? What is the default rate for the GII?
Okay, I don't have the actual default rate for GII, but if you look at it, uh, Malaysian bonds have performed relatively well this year. A lot of money a lot of funds have been has been drawn out from the equity markets and into bond markets. So yeah, I would think that certainly it's very much also dependent on our currency performance. So right now, I think the consensus is that the ringgit might dip below uh, the 4 ringgit threshold. If it does, I would think that there will still be a strong demand for the Malaysian bonds. So yes, so the Malaysian bonds definitely are looking relatively attractive at this point, given that the yield on Malaysian bonds are likely to stay elevated on two fronts, given that the US might and is likely to reduce interest rates further. So that gives the Malaysian bonds a little bit more upside potential in 2026.
Hi, for the stock, we will keep it for later, okay? But we will continue to answer those that is not related to stock pick. For the stock pick one, we will relate it to, we will pass it to Kenneth, in the later sessions, all right? So, so Kenneth, there's a question for you. Okay, so what are the stock pick? How do you find the Sunway stocks?
Stock picks wise, we'll leave it for the later session. For Sunway wise, I think the outlook appears to be still relatively bright. I think the key catalyst will be the spin-off of the healthcare healthcare segment. That will be the main catalyst for Sunway's growth story moving into this year.
Right now, we'll pass the sessions to continue about the market outlook.
Okay, moving on to the global market review. After having registered a relatively solid performance over the past 9 months in 2025, global markets rarely lost steam in the final quarter of the year as further gains were tempered by renewed volatility arising from uncertainty surrounding the record-long US government shutdown that lasted 43 days and mounting concerns over stretched valuations among AI-related players. Still, global markets held firm and eventually marched higher, supported by rising expectations of monetary policy easing that were ultimately validated when interest rate cuts materialized in both November and December last year. Despite a choppier fourth quarter in 2025, US equities still managed to register modest gain for the quarter. While the advance was uneven, largely due to concerns over the stretched valuations, particularly among AI-related themes, the resumption of monetary policy easing by the US Federal Reserve continued to underpin Wall Street resilience. Consequently, all three major indices closed in the green during the quarter. Over at Europe-wise, European equities also closed green on favorable macroeconomic conditions. The ECB kept interest rate unchanged since July 2025, citing resiliency in economic activities, and inflation is hovering close to 2% target. Notably, the FTSE 100 outperformed with 6.2% Q-on-Q gains after topping the 9,900 points in mid-November. It subsequently closed 21.5% year-on-year higher after Bank of England kept benchmark interest rate unchanged, while the country's manufacturing PMI data rose to 50.2 in the month of November 2025. This marks the first reading of expansion since September 2024. Closer to home, Asia equities extended their rally into the final quarter of last year, supported by attractive valuations as well as further clarity over US trade policies. The Hang Seng Index, however, declined by 4.6% Q-on-Q, mainly pressured by profit-taking in tech-related stocks. Still, the Hang Seng Index managed to cap off the year with 27.8% year-on-year gains in last year. Over at Malaysia-wise, the FMKLCI ended fourth quarter higher by 4.2% Q-on-Q, largely driven by the rally in the final weeks of the year on the back of window dressing activities after the benchmark index was traded largely directionless in the absence of fresh domestic catalysts, while the latest round of corporate earnings offered little positive surprises. Sentiment across the lower liners, however, softened, with the FM small cap and FBM Ace posting negative 5.3% and negative 5.8% Q-on-Q declines, respectively, as profit-taking activities set in following the strong rallies in the previous quarters. For sector-wise, it was fairly mixed during the quarter, with the finance sector leading the pack, climbing by 8% quarter-on-quarter. This also led towards the outperformance of the FMKLCI. The improvement was backed by the stable loan growth and asset quality, along with sustained profitability in line with solid domestic economic growth. On the flip side, the utility sectors underperformed by negative 10.7% Q on Q, uh, following the earnings disappointments from utility giants such as Tenaga, YTL Power, YTL, and Malakoff. For foreign funds flow-wise, in last quarter, foreign investors remain net sellers in Malaysia equities with net outflows totaling 5.9 billion. This brings 2025 cumulative net outflow to more than 22 billion. The outflow was largely absorbed by domestic institutional investors with net buying position totaling 7.2 billion during the quarter. Meanwhile, retail investors were net sellers with outflows of 1.3 billion. Despite the weaker sentiment, trading activities improved with both average daily traded volume and so value improved during the quarter as selling activities escalated following the strong strikes delivered in the prior quarter. At the same time, trading interests were largely skewed towards larger cap stocks, in evidence of the stable performance on the local bourse vis-a-vis the lower liners. For the global equity market outlook-wise, global markets appears poised for further upside, underpinned by several key factors such as the sustained corporate earnings momentum, lower interest rate environment, easing trade policy headwinds, and continued investment in AI-related developments. Despite lingering tariff effects filtering through the supply chains, biting into corporate margins, and rising consumer prices, equity valuations remain reasonably attractive relative to forward averages, suggesting that upside potential is still very much intact at this point of time. With the US Federal Reserve Chairman Jerome Powell's tenure set to end on 15 May this year, longtime advisor of US President Donald Trump, Kevin Hassett, has emerged as the leading candidate to assume the role. His potential appointment has fueled expectation of more dovish policy tilt, reinforcing market projections of at least 2 to 3 times of rate cuts moving into this year. This could further shape liquidity condition and risk appetite across global markets. Meanwhile, investors will also keeping on to a close watch on the US midterm elections, but this will likely to take place in the second half of this year, tentatively on the 3rd November 2026. Markets often experience heightened volatility in the run-up of US midterm elections as investors grapple with policy uncertainties, shifting political dynamics, and potential changes in the balance of power. From a valuation perspective, the MSCI All World Index is trading at 4 PE multiples of close to 20 times for this year and 18 times for 2027, both of which seem to be relatively below the 5-year historical average of 20.5 times. This implies global equities have not fully reverted to levels typically seen during the periods of elevated optimism. US equities remain reasonably valued with S&P 500 trading at 4 P multiples of 23.6 times for 2026 and 20.7 times for 2027, both comfortably below the 5-year historical average of 25.2 times. Earnings growth prospects will continue to emanate from AI-related theme heading into this year, underpinned by resilient structural demand and continued deployment of capital across the broader technology value chain. Elsewhere, the MSCI Europe Index is trading at 4 PE multiple of 16 times and 14.4 times for 2026 and 2027, which is also well below the 5-year historical average of 17 times. However, this valuation discount reflects persistent concerns over Europe's structural challenges, including aging demographics, uneven productivity improvements, and a slower industrial recovery, all of which weigh onto the overall region's economic growth prospects. The MSCI Asia ex-Japan Index is trading at 16.7 times P multiple, which is still below its forward numbers of 14.3 times and 12.5 times for 2026 and 2027 respectively. On a relative value basis, the region remains appealing, underpinned by lower interest rates, robust earnings growth, ongoing improvements in corporate governance, healthier fiscal balances, and resilient global demand. Global corporate earnings growth has been revised higher to 14.5% year-on-year for 2026, up from 12.9% from the earlier projection, and 13.5% for 2027. Growth is expected to be fueled by a combination of macro policy and structural drivers, such as lower interest rate environment as major central banks are still pivoting towards easing cycle, resilient and gradual economic growth along the contained inflation, investments in AI infrastructures, and easing input cost pressures amid stabilizing supply chains. Over at the US, S&P 500 earnings growth projection is at 15.4% and 10.7% year-on-year for 2027, respectively. On this, the growth is in reflection of the easing monetary policy conditions, as interest rate cuts lower financing costs and improve demand visibility. Meanwhile, the earnings in the MSCI Europe Index are set to climb 10.2% year-on-year and 10.8% year-on-year for 2026 and 2027 respectively, on easing monetary conditions and sustained fiscal spending, particularly on infrastructure and defense-related sectors. Elsewhere, the MSCI Asia ex-Japan Index is seeing an increase in its earnings growth forecast of 20.1% and 28.2% for this and next year. Earnings growth will be emanated from resilient domestic demand, rollout of stimulus measures from Chinese government, and accelerating investments into the technology. On the Malaysia equity market outlook-wise, looking ahead, the second tranche of the 100 ringgit under the Sumbangan Asas Rahmat Sara program, scheduled for disbursement in mid-February 2026, is expected to sustain domestic consumption moving into the first quarter of this year. The additional cash assistance should help support household spending, thereby cushioning the impact of rising cost of living pressures and lending support to consumer-related sectors during the earlier part of this year. Meanwhile, the impact of tariffs is expected to become more pronounced as we move into this year, as the higher trade costs gradually filter through supply chains and corporate cost structures. Nevertheless, the agreement on the reciprocal trade ART signed on 26th of October last year, which covers more than 1,700 key export lines with reduced exempted tariff to the US, is expected to provide a measure of stability and mitigate downside risks for Malaysia key exporters from 2026 onwards. Bank Negara has kept the OPR rate steady in the latest monetary policy meeting. Consensus expectations are perceiving that the current accommodative rate environment to be maintained throughout this year under the prevailing manageable inflation and sustained economic growth outlook. In terms of the exchange rate rise, the ringgit has strengthened more than 10% against the US dollar in 2025, making it Asia's top performing currency. With the US rate cut narrative remain on the forefront, the continued narrowing interest rate differential between the Malaysia OPR and the US Fed funds rate is expected to remain supportive towards the ringgit strengthening prospects. We favor several sectors moving into this year. Firstly is the Visit Malaysia Year 2026, a theme surreal experience, aims to showcase Malaysia's rich cultural diversity, natural attractions, and adventure offerings, and is expected to drive a meaningful uplift in tourist arrivals, with Malaysia Tourism Promotion Board targeting 47 million of visitors in this year. This compared to about slightly more than 30 million of Malaysia's tourists in Malaysia in 2025. These anticipated tourism upcycles should bode well for the retail and broader consumer sectors, coupled with the second tranche of the SARA 8 program. Both consumer staples discretionary players are well positioned to benefit from a more supportive consumption environment. After a period of underperformance in the fourth quarter of 2025, valuations within the construction sector have turned more attractive, with the sector now trading at prospective PE multiples of close to 16 times and close to 14 times for 2026 and 2027 respectively. which are well below its one-year historical average of 29.4 times. Just a recap that the construction sector has fallen by about close to 10% in the fourth quarter of last year. Looking ahead, earnings reflection from the contract wins last year will likely to materialize, and the sector prospects are reinforced by the steady pipeline of projects driven by continued AI-related infrastructure in data centers, as well as the rollout of several mega infrastructure developments. The RE sector remains as the key focal point in line with the government's aspirations to achieve 70% RE capacity in the nation's power grid by 2050. Introduction of the 2 gigawatt solar capacity under the large-scale solar 6 LSS6 along with the additional 300 megawatt under the feed-in tariff for new biomass, biogas and mini hydro projects with application from 10 of February this year is expected to keep RE players busy in coming years. Also, the introduction of a carbon tax this year could also accelerate the energy transition, which bodes well for the RE sector as well. In terms of projected earnings wise, the FMKSI earnings is projected to grow at 6.1% year on year, underpinned by several factors such as the gradual improvement in loan growth and stable OPR, which bodes well for the banking sector that accounts for roughly 40% of the FMKSI weightage. Sustained domestic spending supporting key consumer household names, and steady power demand benefiting utilities giants. However, we reckon that valuations appears to be less appealing, with the FMKLCI trading at 15.2 times is already close to its 5-year historical average of 15.9 times, suggesting that the corporate earnings will need to outperform expectations to justify further upside to the key index. After a relatively underperformance in 2025 against most regional peers, the FMKLCI looks to play catch-up moving into 2026. The local boss is looking to build onto its recent strides from the final weeks of 2025, with the 1700 psychological level in focus, followed by the next resistance at 1730 points. On the flip side, any retracement could see this 1620 points serving as the near-term support, followed by the 1600 psychological level. It is also worth noting that the benchmark index has staged a meaningful recovery from April 2025 lows at around 1400 level. From a technical perspective, the FMKLCI has advanced by approximately 20%, effectively signaling its entry into the bull market territory. So that's all from my end, and we shall move on to the stock picks for this quarter.
Hi, Kenneth. There is one question from the floor. So, there's an audience asking, do you think renewable energies and construction sectors will be performing well as last year?
Yes, I think renewable energies will likely to continue to benefit from various incentives outlined under Budget 2026. Most of the players will likely to remain fairly busy in this year. It will also be an execution year for 2026 for the RE players. For the construction sector-wise, we see a strong pipeline of projects being dished out in 2024 and also 2025. So 2026-wise, it will be a years of earnings materialization. So we'll see earnings trickling in. That would likely to justify the performance of the outperformance of the construction sector in 2025. So 2026 will likely to see probably a strong uptick in the earnings growth from the construction sector.
Thank you, Kenneth. So next, I will pass the stage to Chu Hong to share about his coverage.
Hi everyone, can you hear me? Okay. Hi everyone. So today I'll be providing two stock picks under the renewable energy sector. First one is SolarVest and the second one is Samaiden. Both of these companies have very good track record in securing the recent LSS tenders, and I believe that with the increasing electricity demand and the policy tailwind under the NETR, these companies will continue to perform well in terms of their revenue in the upcoming years. So firstly on SolarVest, SolarVest is the largest pure play solar player in Malaysia, having awarded at least 30% of market shares in the past LIS programs, with its market cap standing at around 2.9 billion. Over time, the company has installed more than 500 megawatt peak of solar PV systems in total, which has very much proven its track records in the past. There are three segments that the company engages in, first being the large-scale solar, which is the solar farm. The other two are the residential and CNI, which are rooftop solars. To date, the company remains very active in pursuing more jobs with tender book for solar and BESS amounting to 9.19 gigawatt peak, and also BESS tender book that is about 909 megawatt hour. It is also very active in expanding its solar assets, with the effective solar assets portfolio currently standing at more than 300 megawatt peak. So overall, the industry remains very exciting, with more job flows expected to come through several initiatives, especially through the government's NETR framework that targets 70% of RE energy capacity by 2050. So overall, we remain very much confident that the solar EPC players like SolarVest, which has a very good bidding track records to maintain its market standing at 30% of market share, the launching of future LSS programs under LSS 5, 5 Plus, and 6, and other programs such as the CREAM and CRESS that builds on the third-party SS framework. Profitability-wise, the module cost remains very much at a steady rate of about 10 cents per watt, and that should provide some margin leeway for now. Coupled with the strong growth under its EPC segment is the expected increase in recurring income through the sales of electricity to either TMB under the LSS programs or CGPP to various off-takers, where the group currently targets the composition to reach 30% of the total revenue by FY27. So with that, we reach our valuation of a trading buy of with a target price of 3 ringgit 51 cents based on the sum of the parts valuation, where our EPCC is based on the 30 times of PE, and the electricity sales are based on a DCF valuation. The ending price today also implied a capital upside of about 12%, and FY27 forward PE remains on downtrend at 32 times, which demonstrates its strong earnings growth projection. So order book for SolarVest remains very robust and stood at about 1.3 billion as of September end. Taking into account the LSS 5 and 5 Plus projects that SolarVest has received, our outstanding order book currently stands at about 1.8 billion, which is very well covered at more than 3 times if we consider FY25's revenue of about 536 million. This again demonstrates a strong market presence in utility scale sector, and we see that the company will continue to perform on volume front while also defending its margin with the current PV module price remain on a low base. Despite the China's involution policy, we continue to see that the global oversupply will not be curbed overnight and should remain quite persistent. In the meantime, US tariffs should continue to divert these supplies into ASEAN and keep the prices low and make the module prices more competitive. Now to some updates on its associates company Keeming, which SolarVest had purchased last year. SolarVest had overall a 30% ownership when it bought over the Keeming stake, and post-IPO we'll see it reducing to 24%. Regardless, overall we see this as a positive development, and with Keeming involving in the M&E segment and maintenance and repair service, we believe that there could be some effective cross-selling, especially seeing that Keeming does not really involve in solar segment, and both have very distinct client profile. There was a 20 million profit guarantee provided to SolarVest over the 3 years from FY25 to FY27. A view that with the public listed status, which will improve the associates' marketability, liquidity, and market presence. There may be a potential re-rating for these associates in terms of a PE ratio to be higher than level where we currently peg, which is 10 times. Pending the finalization of IPO price and its expansion plan, we have yet to reprice the contribution for now. So onto its Financial highlights. Overall, there hasn't been much change in terms of year-on-year revenue and earnings growth from last period. When the last period, we also saw that the PATAMI had actually grew more than double, and in this quarter, it stayed pretty much in the same pattern where it grew more than double. And this is actually mainly due to the high LSS project recognition under the CGPP program. And we do not expect the recognition to slow down following the completion of CGPP, which is expected by the end of 2025, where the revenue gap will very much be filled with LSS 5 and 5 plus recognition that will soon start to take effect. So meanwhile, in terms of quarter-on-quarter basis, PATAMI has also rebounded in line with the expansion of its revenue due to the CGPP being near completions, with higher margins recorded for these programs as well. So onto its outlook, following the completion of LSS 5 and 5 plus, we see that the EPCC order book will continue to be filled by steady CNI, which we expect about 200 million of contribution per year. And LSS 6 will likely be launched early next year in 2026. We'll have about 2 gigawatt of capacity. Meanwhile, the adjustment of CREST and CREAM SEC charges of up to 40% will also likely help to improve the project viability under the third-party access model. And also, the battery costs continue to stay at a all-time low, and we expect the incorporation of BESS elements in LSS 6 to enhance project value and also maybe provide some margin expansion. After considering the technical complexities and high integration requirements, which will allow solar EPCC companies to gain on volume and margin fronts, especially for the already established market player like SolarVest, which we expect to gain the most due to its established market presence at 30%. Meanwhile, other broad-based drivers include the higher base electricity tariff, which was revised mid-year last year, and this could provide acceleration for solar adoption, together with the newly introduced ATAP that does not have quotas restrictions, and we expect this to improve adoption for CNI clienteles that requires greater system sizes not permitted under NEM Nova previously. Now on to the second stock idea, Samaiden Holdings. So Samaiden Holdings similarly very much involved in the EPCC segment, where solar EPCC forms the primary driver of its total revenue at somewhere around 98%. However, it is different from SolarVest in a way that it also very much involves in the EPCC of biomass, biogas, and mini hydro. Overall, we like this company due to its comprehensive solutions for clean energy that goes beyond just solar, which could provide more favorable margin mix in the longer run. But regardless, its solar EPCC remain quite substantial at an estimated 10% of the LSS shares based on its past bidding records. I also see that bioenergy segment will provide earnings diversification opportunities and provide a greater foothold for it to reap any opportunities in the future to benefit from potential accelerations of bioenergy capacity requirements in Malaysia. Its current market cap is standing at 690 million, which is relatively smaller compared to SolarVest. And the company divides their segmental revenue into EPCC, solar PV, and other segments, which mostly includes O&M service. Currently, the group is also targeting to increase its recurring income base to 10% over the next 3 years, and it is actively developing more than 270 megawatts of assets that spans across LSS, biomass, and biogas. So similar to SolarVest, Samaiden is also expected to benefit from the NETR framework. Meanwhile, there will be a gradual ramp up of recurring revenue to 10% from the ownership under LSS, biogas, and biomass, which most of them are targeted to be completed by 2027. We think that Samaiden's proposition remains interesting based on its multi-technology solutions that is not constrained by only the solar energy segment, and also the potential earnings risk profile improvements through asset ownership over the next 3 years. With a consensus fair value of 1 ringgit 76 cents, Samaiden is providing a potential upside of 28% from the closing price of 1 ringgit 38 cents. With that, we think that its valuation remains relatively undemanding, with an FY27 forward PE of 22 times compared to the sector average. So these are some of the assets under development, which most of them will be targeted for commencement in 2027. Onto the financial highlights, the revenue has grown quite impressively at 32.9% based on a 3-year CAGR from FY22 to FY25. And the earnings has also grown by 19.2% based on a 3-year CAGR, which is very much in tandem with the top line growth. Growth is mainly due to the higher utility scale contribution for CGPP, and we expect the growth to continue into FY26 with the near completion of CGPP and another round of LSS 5 and 5 plus recognition, where some item were likely to take at least 10% of market share. This is despite a rather flattish gross margin outlook for utility scale solar at around a high single digit level, which remains quite defensible with PV module prices expected to trend flattish for now. Overall, Samaiden has targeted for a 1 billion order book by end of 2025, and the latest order book for September month end, which was its first quarter FY26, stood at 617.5 million. For outlook in terms of solar sector is similar to SolarVest. I will not be repeating them here, but I wish to highlight that the near-term opportunities Samaiden will involve in will be the additional quota under feed-in tariff 2.0, which will be launched in 2026, where there are in total 300 megawatts of quotas available, divided into biomass, biogas, and mini hydro at 150, 50, and 100 megawatts respectively. So with that, I'll end my presentation for today. I'll now pass it over to Chloe to continue her presentation.
Good evening, everyone. Today I will be presenting two companies. I will begin with Formely Corporation Berhad, which we have recently initiated coverage on. So a brief overview of the company. Formely is principally involved in providing advanced precision cleaning, surface treatment, and engineering solutions, mainly serving the semiconductor and oil and gas industries. The semiconductor segment is Formly's key growth driver, supported by its significant exposure to Taiwan, which contributes over 60% of the group's revenue. The group serves more than 100 customers across Taiwan's semiconductor ecosystem. Formly's core expertise lies in advanced precision cleaning and surface treatment for semiconductor process equipment components. In wafer fabrication, these components are repeatedly exposed to chemical and particle contamination, which could compromise wafer yield. Precision cleaning is therefore critical to maintaining equipment performance and extending the lifespan of the equipment. In addition, Formly operates an engineering segment, which contributes less than 20% of the group's revenue. This segment provides maintenance and overhaul services for rotating equipment used in the oil and gas, energy, and power generation industries through its subsidiaries in Malaysia, Singapore, and the Philippines. So we initiated coverage on Formly with a buy recommendation and a target price of 5.15 ringgit, based on a target PER of 40 times, which is half a standard deviation above its average 1-year forward PER, and pegged to our core CY27F EPS. Based on today's closing price of 4.15 ringgit, this implies an upside potential of about 24.1%. While this represents a slight premium to the average forward PER for domestic technology peers, we believe it is justified given Formly's front-end positioning, which allows it to capture growth earlier in the structural semiconductor upcycle, unlike other local technology firms that focus on back-end assembly or equipment manufacturing. Our buy recommendation is underpinned by Formly's strong growth prospects. Firstly, the global semiconductor industry is entering a new growth phase, driven by rising demand from AI, high-performance computing, and data center infrastructure. As wafer starts and utilization rates at advanced nodes increase, the serviceable market for precision cleaning and surface treatment expands accordingly. In this context, Formly serves as a high-quality proxy to front-end semiconductor growth, offering indirect exposure to wafer fabrication activity through its role in maintaining advanced manufacturing equipment. Frontend has also established long-standing relationship with Taiwan's top-tier foundries, and this highlights the group's strong technical credibility and deep integration within advanced node manufacturing. As fabrication processes become more complex, Frontend's proven capabilities allow it to capture higher value and more margin-accretive work. Furthermore, as leading foundries migrate to next-generation nodes, equipment utilization intensifies and servicing requirements becomes more specialized. This positions Frontend to benefit not only from higher servicing volumes but also from increasing value per job and stronger margins. Frontend's Taiwan subsidiary currently operates 2 plants in Tainan and Kaohsiung. To support rising demand, the group is actively expanding its plant capacity with additional production lines planned at both plants. In addition to that, in March last year, Frontend acquired a 3,800 square meter plot of land in Tainan for 23 million ringgit, strategically located near its existing Plant 1, which provides further flexibility for future expansion. Meanwhile, Frontend's engineering segment offers an important diversification avenue. While it currently contributes less than 20% of the group revenue, it provides a stable recurring income stream and offers upside potential should oil prices, capital expenditure, and maintenance cycles improve. Last but not least, Frontend also maintains a solid balance sheet, supported by minimal borrowings and a steadily expanding cash position. This financial strength enables the group to fund ongoing capacity expansion and strategic investments, while continuing to deliver sustainable dividend payouts. Although Frontend does not have a formal dividend policy, it has historically distributed 30 to 60% of its PATAMI over the past 5 years. Additionally, the group has approximately 400 million outstanding warrants expiring in May this year. So, if fully exercised, it will provide further cash inflow and enhance financial flexibility. Alright, now let's move on to the financials. Frontend's earnings have demonstrated a consistent long-term uptrend, broadly tracking the semiconductor upcycle. The only notable interruption occurred during 2022 and 2023, when a global semiconductor inventory correction led to temporary softness in front-end demand and moderation in servicing activity. Looking ahead, Frontend remains well-positioned to sustain its growth momentum. The ongoing semiconductor upcycle, together with the rising adoption of advanced nodes, continues to increase the demand for front-end servicing. Meanwhile, the expansion of its Taiwan operation is expected to support higher servicing volumes from major customers, while the continued migration to advanced nodes should increase both the technical intensity and the value of services provided. Outside Taiwan, contributions from facilities in Malaysia and Singapore are expected to grow in line with the broader semiconductor upcycle and the gradual onboarding of new customers, although the growth in these regions will likely be more measured compared to Taiwan. So taking all these factors into account, we believe Frontend is well positioned to benefit from long-term structural growth in the semiconductor industry. So that concludes my first topic, and I now move on to my second pick, which is Technoration Berhad. It is a semiconductor company that focuses on advanced packaging and back-end equipment manufacturing. Over the years, the group has expanded vertically along the semiconductor value chain, evolving from an equipment-centric business into an integrated solutions provider. The group currently operates across 3 business units. The first one is the Semiconductor Equipment Business Unit, or SEBU, which involves in the manufacturing and sale of semiconductor equipment used in assembly and packaging, vision inspection, die bonding, and final testing. It designs and it develops its own in-house brand series with operations spanning Malaysia, Korea, and China. The second unit is the Semiconductor Material Business Unit, SMBU. This segment focuses on the manufacturing and sale of solder spheres, which are a critical assembly and packaging material in the semiconductor industry. Its business footprint covers Taiwan, China, and Singapore. In 2022, the group commenced the development of its third business unit, which is the Semiconductor Solutions Business Unit (SSBU), as part of its strategy to become a fully integrated solutions provider. This unit achieved a key milestone in June last year with the successful completion of its first power module prototype on the in-house power module pilot production line. Qualification work is currently progressing as planned, and this is expected to lay a strong foundation for long-term opportunities in automotive and industrial power applications. Looking at this recent financial performance, MITEC delivered record earnings for the first 9 months of CY25 and surpassing the entire earnings of CY24. This was driven by robust growth in both the semiconductor equipment and semiconductor material business units on sustained demand for advanced packaging solutions. So we remain positive on the group's growth trajectory over the coming quarters, supported by higher machine deliveries for the fast-growing advanced packaging segment, particularly within the mobility and wearable space, where the group continues to gain market share. And at the same time, demand for solar spheres remains firm. The group's new plant in Senai, Johor is progressing as scheduled, with construction targeted for completion by May this year. This will be followed by production equipment installation and trial runs, as well as sample submissions expected by the end of the fourth quarter this year. Once operational, the facility will add 7 new production lines, increasing capacity by approximately 210 billion solar balls per month. With the strong growth prospects, we reiterate our buy recommendation of MITEC with a target price of 3.55 based on an unchanged target PR of 28 times back to our CY26 EPS. Based on today's closing price of 3 ringgit, this represents a potential upside of about 17.2%. From a technical perspective, MITEC is in a well-established uptrend. In last Friday's Technical Edge report, we highlighted that MITEC had peaked in mid-November and entered a period of mild pullback and consolidation. At that time, we noted that price stability above 2.75 ringgit was constructive, and we were looking for a potential breakout above 2.95 ringgit to signal the next leg higher. And since then, the price action has moved in line with our expectations. It has successfully broken above the 3 ringgit resistance zone today, confirming the end of the consolidation phase and the resumption of its upward trend. The breakout is supported by improving volume, suggesting a strong market buying interest, and now the price is trading above its key moving averages. As such, we see scope for further upside towards the 3.17 ringgit to 3.35 ringgit resistance range, with 3 ringgit now acting as an important support level. Thank you, and this comes to the end of my presentation. I'll pass the floor to Jessie to continue.
Hello, good evening, everyone. So I will be introduced Infomina and Inter-Pacific this time. So Infomina is the IT solution provider which appoint as a reseller and distributor of Broadcom software technologies under a regional partner agreement with CA Singapore Broadcom. It is also recognized as a premier tier 1 value-added distributor for marketing Broadcom software technologies across the countries in the Asia-Pacific region. So Infomina generates its revenue through 2 segments, which is turnkey and renewal segment. Turnkey segment mainly involved in designing and implementation of technology application and infrastructure solutions, while renewal segment is providing ongoing technology infrastructure operations, maintenance, and support services. It has been a busy period for Infomina over the past 2 months, as the group has secured 3 renewal contracts from its existing clients. So under these renewal contracts, Infomina typically undertakes business activities such as renewing license subscriptions, providing training to bank personnel, delivering online and offline support services, performing periodic software maintenance, offering ad hoc technical and repair services, as well as monitoring and reporting on software consumption and utilization. So combining these three contracts will give about 282.4 million, with a contract duration ranging from 2 to 3 years. And these contracts are expected to contribute about 90 million to 96 million in their gross profit. So to highlight Infomina near-term outlook, its order book currently stands at 291 million with a tender book value at 972 million as at end of August last year. But looking ahead, we expect the order book replenishment of about 400 million for its financial year 2026, which end at May. So supported by contract renewals and potential capacity upgrades from its key existing clients. Together with the 3 recent secured renewal contracts, we forecast a revenue growth of 30.5% and core earnings growth of 31.2% in financial year 2026, driven by higher project recognition and improved margins from mainly the renewal contracts. So we reiterate our buy call on Infomina with a target price of 1 ringgit 81 cents, which implying an upside potential of 32% based on yesterday's closing price of 1 ringgit 37 cents. And next, I will introduce Inter-Bina. So we initiate coverage on Inter-Bina last year during the fourth quarter of 2025. So Inter-Bina is a Malaysia-based main contractor that specializes in building works. So over the years, Inter-Bina has completed a wide range of projects, which includes residential properties and non-residential properties, with high-rise residential developments being its core expertise. The completed projects are concentrated in Klang Valley, and in addition to being involved in the main building works, Inter-Bina is also involved in the property development and lift installation businesses. So as a main contractor, Inter-Bina has established long-term relationship with the local property developers such as Gamuda, UEM Sunrise, Masing, Mitraland, and Ecowork. Inter-Bina further expanded its client base by onboarding Avaland in 2024 and IGM Corporation in 2025. So this long-standing relationship with major property developers, coupled with the consistent client base expansion, further enhance Inter-Bina's prospect of securing new contracts. With Inter-Bina's re-entry into Johor, the group is expected to have a higher likelihood of securing new contracts from its recurring clients with a strong presence in the state, such as Ecowork and Masing. This is supported by the ongoing housing boom, driven by industrial and commercial expansion, particularly within the Johor Singapore Special Economic Zone and the Johor Bahru Singapore RTS link developments. Inter-Bina's tender book currently stands at 4.5 billion, with the majority of the tenders originating from the Klang Valley, while the smaller portion is from Johor. And then IJM, Samdabi Property, TA Global, Ecowork, and Masing are the group's top 5 clients by tender value by far. So in terms of its property development segment, Inter-Bina diversified into this segment with the launch of its maiden project, Senuri Residence, back in October 2023, which has achieved a take-up rate of 87% to date. During December 2024, Inter-Bina acquired a piece of freehold land parcel for its Bukit Jelutong project. And this project is planned to comprise shop lots and services residents, which target to launch in this quarter. Besides from that, Inter-Bina also acquired a company with development rights over 2 parcels of land in Glamoury from the Selangor Housing and Property Board. So this Glamoury project is planned as a mixed development, which comprise open market units and Rumah Selangor Co. Affordable housing, which target to launch in next year, first quarter. We estimate that The selling price of both upcoming projects will be below 500,000 per unit, with total estimated gross development value which over 500 million. So revenue and earnings growth in recent years have been supported by strong construction project recognition and the 87% take-up rate at its maiden development in the property segment and improved operational efficiencies. So looking ahead, we expect the 1.9 billion outstanding order book under the construction segment, together with our in-house order book replenishment assumption of 1.1 billion, unbilled sales of 90 million from Senuri residents, and the launch of the Bukit Jelutong project for this quarter to drive the revenue for the calendar year of 2026. So consequently, we forecast core earnings to grow by 24.1% to nearly 40 million this year. So we initiate on a buy call on Interbina with a target price of 82 cents based on the sum of the parts valuation of CY26, with our construction segment is pegged to a 10 times PE multiples, and the property development segment is based on a 25% discount to the realized net asset value, which implies an upside potential of 105% based on yesterday's closing price. That's all from me. I will pass it to Kenneth to continue.
Okay, I'll continue with the technical outlook. The FKR is currently taking a breather right now, digesting gains from the year-end rally. Should the 1645 level support level remain defended, the index could extend its recovery trend to potentially towards the next resistance at the 1720 towards the 1760. Meanwhile, near-term support is located at 1645, followed by the 1600. On the FCPO rise, is not looking too good at this moment and is currently still on the correction phase, forming the lower high and also the lower low formation. For now, let's see if price could establish a base at above the 3009. And in order to confirm for a recovery, price needs to rebound above 4100 to target the 4225, followed by the 4347. Supports are at 3907, followed by the 3813. But on the good news right now is that if you look at this chart right now, although it's still on the pullback mode or the correction mode, we notice that there's a potential bullish MACD divergence, whereas the MACD indicator turning higher in recent months. So this suggests that downside will likely to be capped at this point of time. On gold prices wise, it's still on the ascending trend right now. However, we need to be cautious over the divergence between the price movement and also the MACD indicator. We are seeing the price has been forming the higher high formation, but the MACD indicator is forming the lower high since middle of October till the recent peak in late December. So for now, the immediate resistance is located at the previous high of 45.25, followed by the 4600. So every $100 will serve as the next resistance. Support at the 4166, followed by the 44,000 psychological level. Over at the FM KLCI wise, is the FM KLCI is turning into a consolidation phase coming off from the victory. Should the 1638 support level remain defended, the key index could extend its upward trajectory towards the next resistance at 1700 towards the 1720. Meanwhile, the near-term support is pegged at around the 1658, followed by the 1638. On the small cap wise, small cap has formed a corrective stance and is currently on the consolidation of phase right now. Traders may anticipate for a potential breakout above the 15,867 to target the next resistance at 16,202, followed by the 16,375. The supports are at 15,480, followed by the 15,286. Okay, Just a quick recap. This was the fourth quarter 2025 stock pick performance in terms of our technical. While yes, underperformed the FMKLCI performance, which was mainly driven by the year-end window dressing activities, with the key index rising 4.1%. However, our portfolio has outperformed the small cap, which has fallen by a bigger magnitude of 4% in the last quarter. In terms of our technical pick for this quarter, our first pick is a Northeast Group. Price has rebounded. Price is very much on the uptrend right now and bounced off the EMA 120 to reestablish the uptrend formation. For now, traders may monitor for potential double top breakout above the 90 cents to target the next resistance at 1 ringgit, followed by the 1 ringgit and 10. Support is at 84 cents. Our next pick is Mitra Jaya. Mitra Jaya has formed a meteoric rise since October last year, and since then, price has turned into a consolidation phase. Traders may monitor for potential resistance breakout above the 71 cents to target the 78 and also the 81 cents. Support is at 66 cents. For MN Holdings, MN Holdings has formed a correction over the past 2.5 months and is currently turning into a rebound formation. For now, in order to trade on MN Holdings, traders may monitor for an impending flag formation or breakout above the 167 to target the 183 and also the 189. Support is at 158. For Life Water, Sabah-wise, price is still very much on the uptrend. Formation is still very much intact, largely supported above the EMA 120 level as well. Price has turned into a short-term consolidation, and traders may anticipate for potential breakout above the 145 to target the 165 and so towards the 160 and so the 165. Support is at 136 on Life Water Sabah. Sunrate has bounced off the 1 ringgit EMA 120 across multiple occasions in recent months. With price continues to form the ascending phase, it has been forming the higher high formation. Although there's a lot of short-term volatility, price continues to form the higher low and so the higher high, and the uptrend formation is still very much intact. Traders can monitor for a potential breakout above the 2.33 cents. The first resistance is at 240 towards the 250. Support is at 223. Our last technical pick for this quarter is PacOnline, where price has formed a correction and is turning into a rebound formation. Traders can monitor for a potential flat formation breakout above the 162 to target the next resistance at 175, followed by the 189. Support is at 153 on PacOnline. Okay, moving on, we have also recently revamped and introduced a new format of the daily technical age reports since early December. Based on our recommendations, the month of December has yielded a decent performance for our portfolio, whereby it has gained about 3.7%, with a win rate of more than 45%, as opposed to a break-even rate of 16% and a lose rate of close to about 38% or 39%. While it has lagged the FMKLCI, which was again driven by the year-end window dressing. However, it has outperformed the FM small cap performance, which has only risen by 0.4% in the month of December. So this graph illustrates the daily performance of our recommendations, which has peaked at the gains of more than 8% towards the late December, before easing slightly to below 4%. But however, for this case wise, most of the time we have outperformed the FM small cap performance and also the FM calcium performance. Only until the final days of the last year, our portfolio performance has tapered off slightly. But still, I think that with 3.7% gains in 1 month, I think it's still very much decent. Also, this is the performance of the daily technical edge for the month of January since the start of the year. I think that since the start of the year, it has also been outperforming the FMKLCI, so the FM small cap. It has made a gain of 6.9% over the past lose rate of about 43%. Yes, outperformed the FMKLCI, which the key index has fallen by about close to 1%. while the small cap has gained by about 1.3%. Just a disclaimer that the past performance does not necessarily reflect or guarantee the future performance. However, we strive to maintain our performance barring any unforeseen circumstances. The technical picks are focused onto a combination of fundamental aspects along with a two-tier screening, with the first layer utilizing technical tools and the second layer using naked eye screening. So that ends the presentation for this quarter. Thank you for tuning in, and we will open the floor for Q&A if there's any.
There's an audience asking, do you think IAB and 99 Spin still have further upsides? IAB and 99 Spin.
I think we do not cover these two stocks, so we cannot comment much on the fundamental aspects. But prospects of this company remains relatively strong at this point of time, especially 99 Speedmart. During the upcoming quarter, we're likely to see another round of strong performance, mainly driven by the Zara program. So we will see strong spending extending into at least the first quarter of this year.
Okay, thank you, Kenneth. Due to the time constraints, we will end our session here. For those questions that we didn't answer, you guys can feel free to drop a message on our Facebook. We will answer it accordingly. Okay. Once again, thank you so much for joining our Market Outlooks, and we will see you in our next Market Outlook. Thank you and goodbye.